Good? Okay, great. Okay, good morning, everyone. Welcome to the Southeast Asia SPAC Conference. Really excited to see such a good turnout this morning. I wanted to talk a little bit about the origins of this conference, which I have to admit have a bit of a peculiar history. My very good friend Jonathan Chan, otherwise known as JC, called me one night in the middle of the night in New York, and he said, I have some exciting news. He said, ARP Group wants to hold a conference in Singapore, and they want me to organize it. And I said, well, JC, that's fantastic. Good luck with that. And he said, well, Crocker, I just have one question. How do you organize a conference? And so I said, well, that's no problem. We can pull together an agenda, we can organize some panels, we'll, get some mailing lists and get publicity, and, it'll be no problem. So we were kind of off to the races. And then he called me back a couple weeks, and he said, Crocker, ARC says they need a little help because having a conference in Singapore is actually really expensive. And so I said, well, that's no problem. So I called a couple of my friends, Drew Bernstein up here in the front row of Markham Asia, Mitch Nussbaum of Loeb & Loeb, Kevin Kelly of Morrow Sodali, and they all said they'd chip in and we'd make the thing happen. And so then we signed a contract with Raffles. We signed a contract with the fabulous Olga Isleris, who was in charge of all the logistics today and all the beautiful flowers and technical organization. I thought we were really, in good shape to have a conference. And then JC called me one more time, and he said, I got a little bit more news. ARC changed their mind. They don't want to have a conference anymore. And I said, well, okay, now we really do have a problem here. And, Singapore, as you know, takes contract law very seriously. So I had these visions of being caned in the street by Raffles and then thrown into debtor's prison. And then Olga, while she's an extremely elegant woman, she made it clear that any short payment of her fees would be paid in fingers. So I was really in a tight spot. But fortunately, I hadn't completely run out of friends yet. And JC was very nice about it. He was very sympathetic. He said, Crocker, I fully sympathize with your problem, and I hope that you solve it. So thank you, JC, for that sympathy. So while most people were celebrating Christmas, I gave a call to George Kaufman from Chardan, which is Chardan, if you don't know them, they're one of the true OGs of the investment banks in the SPAC world. They're there from the beginning. Alex Jin from Maxim Group, an investment banking firm that recently agreed to merge with Freedom Group. Tony Tian from Tiger, one of the most active players in China-U.S. cross-border. Chrissy Albeck, who's kind of the dean of accounting for these SPACs and de-SPACs. David Liu of Kroll, Ivan Kwan of Lockton, and then Leon Yi of Duane Morris. And this is the law firm that you want to call once you've finished your G-SPAC and then suddenly the SEC and DOJ want to have a very serious conversation with you. He's the one to call, so just note that name. And thanks to the generosity of all of these sponsors, I can stand on this stage today rather than waving at you from behind the bars of a cell somewhere in Singapore with a stumpy finger. So I really want to thank all our sponsors, and I think we should give them a round of applause because otherwise we wouldn't be here. So that leads us to the next question, which is why are we having a conference about SPACs right now? Because if you read the headlines, you'd think, SPACs are a thing of the past. And I was meeting with one of the large investment banks last week, and he said, are SPACs even still a thing? And, I would say, yes, they're very much a thing. In fact, it's where the vast majority of our new clients are coming from, and it's where I see Most of the transactions that are actually getting done in the capital markets these days are through de-SPACs rather than through traditional IPOs. So one answer as to why we have this conference is that either I'm a contrarian or I'm a masochist. So you can judge at the end of the day, which is true. But I do think if you follow history, that the biggest gains are always made in the wake of a market crash. Now, most of you look too young to remember this, but for those of you who were brave enough to sort through the wreckage of the dot-com crash in 2000, they made, if they picked the companies that were going to survive, they made tremendous amounts of money. And similarly, in the wake of the global financial crisis, you could pick almost any sector and do extremely well. Now, I don't presume to know where we are in terms of the macro cycle for equities in general, but I can tell you that for SPACs, we are definitely at or near the nadir of the market, and so it's only up from here. So the biggest advantage that SPACs have for a private company is the certainty of outcome. If you follow the rules and follow the process, you know that at the end of the day, you will be public. And that's not necessarily true for an IPO. You can spend a year of your life on an IPO, the market conditions can turn, and you may end up not actually making it out of the gate. The big advantage that I see to pursue a SPAC in these markets is that as a public company, you actually have a lot more flexibility and speed to raise capital than kicking off the IPO process from start. So if you believe that over the next 1 to 2 years that the markets will come back, there is a real argument for getting public now, raising a reasonable but not necessarily enormous amount of capital in the process, and then positioning yourself to raise capital over time. And I think the argument for the U.S. markets are several. One is for a number of sectors, you just simply cannot match the liquidity that's offered in the U.S. markets, the depth of analyst coverage and expertise, both on the buy side and the sell side that's offered in the U.S. markets, and most importantly, the flexibility in terms of raising capital once you are public. If you look at the other markets around Asia, none of them have the combination of all three of those things. And I think that's what accounts for the continuing draw of going to the U.S. And right now, the SPAC merger is really the viable path to get there. The other urgency for holding the conference today is that as of today, there's about 340 SPACs that are funded and have not yet found or announced deals. And I think that's important because it means if you have a quality operating company, you have a lot of negotiating leverage right now. And in some cases, the SPACs will use some of their sponsor shares to incentivize people to stay in the deal or sweeten the deal. There's a lot of aspects that you can use to your favor as a quality company. Because for a SPAC manager and SPAC sponsor, this is really a digital outcome. If they fail to find a target, they lose all of the money that they've invested in that vehicle over the last 2 years, as well as all the time that they've spent in the process. So they're very heavily incentivized to find a quality deal that they can believe will be marketable and successful as a public company. So those are some of the reasons why we thought this was a great time for matchmaking here in Southeast Asia between U.S. SPACs primarily and Southeast Asia operating companies. So then the next question, and I think this is more for our visitors from overseas, is why Southeast Asia? Why focus on Southeast Asia now as opposed to other parts of the world? And I think there's going to be a tremendous amount of education that has to happen among the U.S. institutional investor base about why they should allocate to Southeast Asia. But if you just look at it, this is a region taken together that has nearly 700 million people, a GDP of nearly $4 trillion. So that's a higher GDP than India, bigger population than the EU. Indonesia alone has 277 million people, so nearly the size of the United States in terms of people, obviously not the same per capita GDP. But I would put it down to three things: demographics, digitalization, and density. So demographics, famously said, demographics is destiny. And demographics is on the side of Southeast Asia and frankly not on the side of North Asia right now. North Asia's populations in most cases are shrinking. Their workforces are shrinking even faster. Their ratio of working population to those older population that need to be supported is changing, that's gonna limit the upside in terms of growth in those economies. In Southeast Asia, you have really the opposite dynamics. You have average ages that are in the early 30s. You have many of these economies are still adding population year over year. Philippines, I was just there, they're adding 1 million people every year to their population. And so the demographics is definitely on the side of Southeast Asia. The other is digitalization. I think for all the tragic outcomes of the COVID crisis, and there really was a difficult period for this region, it drove digitalization in a very profound way. And that's for anybody who's come here and now relies on Grab to get around. That becomes obvious that on a B2C basis, that's true. But I think as you look across the entire spectrum of B2B businesses and B2B2C businesses, digitalization has just been very widely adopted. And in Southeast Asia, in a way like China, had a chance to just bypass whole generations of infrastructure that was embedded and go straight to the newest technology. And I think that creates room for new business models and dynamic businesses. And then the final part is density. So, and when I say density, it's first of all the trend towards urbanization, which here is still ongoing theme, but it's also density of infrastructure. This is generally a region that governments invest well in infrastructure. But most of all, it's about people and capital. So if you look at the first generation of companies from Southeast Asia that went public, and so looking at C, which was the first major IPO in the NYSE, Grab, Goto, Lazada, Bukalapak, Traveloka. What's notable is that their alumni network have gone on to found thousands and thousands of startups across the region. Now, the nature of the startup is that not all of those are going to be successful, but there are just so many that are working to build innovative new businesses, and they've now had the experience of working at companies for 5 or 6 or 8 years and seeing them scale as digital businesses that are often pan-Southeast Asia businesses. I think that's a huge advantage. And then finally is density of capital. And here I think Singapore really will play a critical role. I've asked different people and I've tried to look up online how many family offices there are in Singapore. And the last published estimate I found was 700 family offices managing $3.5 trillion. But then I was having a conversation with somebody who's in that business, and he said, no, actually the backlog of family offices that are in process is over 1,000 that are trying to form right now in Singapore. So if you just think of the amount of money that's coming, whether it be out of China or other parts of the world, and Singapore has become this locus of investment. So that's very important. I think the other thing about Singapore is that, and it reminds me of Israel a little bit, you have a per capita GDP that's higher than Japan, higher than the US, but you only have 5 million people. So if you're a founder here in Singapore, just like in Israel, from the very beginning, you have to think globally. You have to think, I'm either going to build a business that scales across Southeast Asia or that just scales globally. And I think that mentality is really, really important. And, having worked, for many years with companies from Israel, you just see that gets embedded, and it becomes this outward looking view of the world. And I think that's why Singapore is just going to be this very critical hub for the direction, for the development of this region. So, I'm all in on this region. I hope maybe some of you who came in here as skeptics, maybe I've convinced you. Those of you who live here, probably I'm saying things you're already more than aware of. And then I think over the course of today, you're going to get what I would call a very fair and balanced picture of where we are in the evolution of the SPAC product. And I think it's really appropriate that we start out with George Kaufman as our first speaker. And again, when I started doing SPACs, there were really only two firms that did SPACs. It was Early Bird and Chardan. That was kind of the end of the story. And so the fact that they, are still, when some of the banks that were very excited about it 2 years ago have now exited the market, that they're here and they're showing up and they're going to tell you exactly what's going on in the market, I think it's great. And so George is he's a partner and he's the head of investment banking at Chardan, and he oversees both the investment banking and SPAC practices. He has a broad experience with cross-border transactions, complex transactions, which describes pretty much every SPAC these days, and SPAC, so it's kind of saying the same thing twice. And under his leadership, Chardan has become one of the most notable underwriters, advisors, and sponsors of SPACs, having been involved in 121 SPAC IPO transactions, raising $15 billion, and doing 51 business combinations. So welcome, George, to the stage. Thank you so much.
Crocker, that's going to be a tough one to follow. I think you covered most of the bases. Thank you. Thank you for that. I don't know if our deck can come up. So as Crocker noted, I'm George Kaufman, partner and head of investment banking at Chardan. We're a globally minded firm, and we've been engaged in emerging markets and emerging growth advisory since inception. That's about 20 years ago. It's about the same time we started our first SPAC, which ended up being the first cross-border SPAC. It was focused in Asia. It was before there was a true use case proven for SPACs, and we jumped in with both feet, and it turned out to be really a great transaction. It opened the door for us to continue to build our practice and for a number of others to get in as well, which helped kick off SPACs in the U.S. anyway. Most of what I'll talk about today, maybe all of it, will be U.S. focused, and there's quite a bit of activity obviously outside of the U.S. We see Singapore changing rules, Hong Kong thinking about it, Europe is getting active, but ultimately I think Crocker made the one point that's key in all this. The U.S. markets are the deepest, most liquid in the world. As long as that's the case, because SPACs are, among many other things, they are liquidity vehicles, that's where they should be. As soon as the other markets start to generate that type of liquidity, it makes sense to start to move them. So quickly, a quick advertisement from our sponsor. As Crocker noted again, we've been doing this for a long time, 20 years in SPACs, and we just tallied up our total aggregate SPAC transactions the other day, 170 plus, I think it's 173, across all different types of SPACs and across all the different permutations that one could see. That's underwriting, advisory, sponsoring, placement agents, investing in sponsors, and all takeovers, restructurings. That happens too. The result of that over a 20-year period, and as many SPACs as we've done, is that we're well positioned to assist others, and we continue to sponsor our own SPACs. So I guess you say we eat our own cooking. We're not advising others to do things that we don't think are wise. We continue to launch our own SPACs to seek viable targets, and we think that they're great vehicles in pretty much every market, because in most markets, they're the only quick, relatively painless, and less expensive path to liquidity. Crocker pointed out again, IPOs have uncertain outcomes. That's really key in uncertain markets. SPACs don't have uncertain outcomes, provided both parties and anyone else who might be tertiary to that agree that they should marry, they'll get married. So that makes them unusual, and the other listing methodologies don't provide that. Even shell reverse mergers don't provide that for a number of reasons we don't need to get into. So, what's a SPAC? Just kidding. But where are we in the market? We think of this as a return to normalcy. We had 2 banner years that had nothing to do with SPACs, had everything to do with a global pandemic, with global stimulus, much of it centered in the United States, people not being able to go to work. They took side jobs as day traders, and a rush of capital into retail hands for equity purposes almost only. The result of that was that anything that was plying the public markets during the years of 2020 and 2021 did really well. Anything. IPOs did really well, SPACs did really well, secondaries were easy to do, et cetera. But of course, that's the period that most people think of when they think of SPACs today, because that's when institutional capital really started to be interested. But prior to that, this was a large and actually growing cottage industry, up to 13 billion in annual transactions. Not huge by any extent, but sufficient to create some really great success stories and provide a viable path to liquidity for a lot of companies. So now we're seeing that shift back. And again, nothing to do with SPACs, more to do with Fed tightening, people having to return to work. They had to quit their day trading job. That's a global phenomenon. And the result, of course, is that with institutions pulling back their capital, favoring other types of credit, with a plethora of great targets having already plied the public markets, at least for their initial listing over those prior 2 years, we're in a rebuilding phase, looking for great targets, potentially improved valuations, and the SPAC teams or the underwriters who can take them out in a regular way IPO. So this is, while it looks like a transition phase, it looks like business as usual to some of us who've been doing this a long time. So speaking of from a investor standpoint, because they really drive the appeal for most sponsor teams, as many have liquidated, as there's a dearth of potentially high profile targets. What's driving sponsor teams' ability to tap the markets and set up a SPAC? Primarily yield players. And no matter what anyone else says, the vast majority of IPO investors in SPACs has always been and probably always will be institutional or institutionally minded yield players. They're looking for an additive yield over treasuries. When treasuries are yielding nothing, it looks cheap. When treasuries are yielding a lot, or relatively a lot as they are right now, it looks expensive. There's been a bit of a yield widening. The history is about 3 points. We're at about 4.5. But we're already seeing in the past just 3 weeks, we're starting to see strong signals of that yield spread declining to historical norms. That's important because as SPACs are depleting through liquidations and business combinations, they're not being replaced at a one-in, one-out rate. And this is arguably a better time to launch a SPAC than any time since early 2019. And this is that story in greater detail. The key element here is in the past year, the number of liquidations, which of course is strong, and it's the headline story for most of the press, as they say, SPACs are out of style, SPACs are out of favor, et cetera. But there are a lot of reasons for the liquidations. It's not only that the sponsors weren't able to find great targets, it's not only that they were concerned with what ultimately would be the trading range of their target. A lot of it had to do with regulation. We've all seen the SEC and even the exchanges jump in and put up various blockers to successful transactions. And more recently in the IRA, there was a tax code change, may or may not have been implemented. Doesn't look like it's going to be that serious, but it scared a lot of larger sponsors into giving back their capital. And so again, this data has not that much to do with SPACs and mostly to do with exogenous forces. But the result is that 13 roughly times the amount of capital has left the space as has come in over the last year. So what does that mean again for a sponsor considering launching a new SPAC? It means, going back in the history of SPACs, we think of it as sort of 1, 2, and 3, or 1.0, 2.0, 3.0. When we first started, and really for the entire nearly 17-year period, it was dominated by small family offices who understood the arguably free yield, historically always free yield, but we can't say, and multi-strats, but small multi-strats. Hedge funds up to maybe $1 billion AUM. Typically nobody larger than that. In late 2019, due to a couple of very important catalysts, largely to do, again, with pent-up retail demand and combining some really interesting business combinations, everybody decided to jump in, and then that was turboed, boosted by the pandemic and the policies around it. And all of a sudden, larger multi-strats stepped in, the household names, and institutions, mutual funds, pension funds, insurance funds that had never, ever played in SPACs, all of a sudden realized that this was effectively a yield instrument with a call option, a free call option. And large family offices stepped in. And then between them and retail investors, which would have made up the entirety of that bucket, but as underwriters, you don't want an entire book taken up by retail for many reasons, most of them good. That became the lay of the land. Today, we've returned. There are some institutions that are staying around because it's still a better yield than most any other instrument out there, if you think about it from a risk-reward perspective. The small family offices are there. The large family offices have largely vacated. And we've gotten back to the multi-strats, and most of them are small, and some of the large ones are still playing, but they're really just dipping their toes. Again, we've seen a similar evolution in SPAC sponsor teams. Initially, mostly unfunded entrepreneurs. That's what we were when we started. We had no real capital of our own, certainly not any institutional grade, but we had a belief in the capital markets, a belief in liquidity, adding value, and a belief in ourselves that we could find great targets. That's usually enough. And then there were some funded deal makers that came in over the years. I won't name names, but they really kicked off the idea that this could be an institutionally serviceable product. Again, 2020 to 2022, dominated by much larger pools of capital. Funded deal makers became, they were all getting the front page of the Wall Street Journal, et cetera. Unfunded deal makers, maybe somewhat similar, but that was actually the largest set of sponsors. And that became risky, because if you don't have real cash and you don't have your own cash, but you think you do, and you think you're a great deal maker in an environment that's only yes, and then it turns on you, it turns out that that's not a great thing, because the entire sales pitch turned out to be wrong. Meanwhile, unfunded entrepreneurs continue to do pretty well, because they don't have expectations of their network that are unrealistic. That leaves us where we are today. I think the point here is that it's largely open. We still have unfunded entrepreneurs, which historically have been the most successful in generating real returns over time for themselves, often for others. The funded deal makers obviously do really well, and they tend to get the high-profile deals. But ultimately, their alpha generation isn't on par with the unfunded entrepreneurs. And then the middle range, they continue to be roughly average. That brings us to sort of from most of this is from the sponsor perspective. What makes the difference? Why sponsor a SPAC? Most people think that it comes down to pedigree. experience and a network and relationships. And if you look at the prospectuses from 2019 to 2022, they are full of names and associations and pedigree. And yet most of those are the ones that are liquidating today. The ones that don't liquidate, and what really matters is, do you have a great set of targets? A really great set of targets, and great in this case, we call it viable, means a target that's likely to merge with your SPAC. It's not that hard of a concept. It is one that isn't unknown. It means as a potential SPAC sponsor, you should know what your opportunity set really looks like. The other is access to capital. If your target is going to need capital, can you really find the capital? Or are you reliant on the market? Because the market's not been giving lately. I think that goes without saying. Today you can raise money, but it's mostly not in equity. And anyone who is relying on third-party capital in the form of equity to close their deal is suffering. Why do we say SPACs are good, given all that sort of negativity? Well, again, I think Crocker said it really well. It is still maybe the best method of applying the public markets in the US. Again, they are generally faster, although not as fast as they were compared to before when the SEC decided to be a bit more firm. They are less expensive paths to taking a company public. Most of the cash expenses borne at the close of the transaction versus at front, which gives whichever party has the best position at the close a chance to negotiate those fees. And the result here is that versus IPOs, we're seeing that SPACs still outperform and are generating more cash to companies, even in this sort of muted environment. This is a more detailed slide to show you just how much more it is. But again, on the blue are IPO proceeds. The combination are de-SPAC proceeds. It's just not all in the form of equity. And I think that's what surprised a lot of people as they found out that the equity markets weren't functioning as they had hoped, but this surprised them to the upside. Because just because the equity markets aren't giving doesn't mean that SPACs can't attract capital, and their flexibility is one of their key benefits. This is the further breakdown, because I think that this is probably the most important thing about SPACs. The equity financing over the past 6 months, just about 2.2 billion, but the vast majority of that came in 18 deals. Everything else is what the rest of the transactions relied on. A combination of different types of structure from different types of investors. You can't do this in an IPO. It's not even legal. It's multiple different deals at the same time. Again, the flexibility of a SPAC allows for this, and allows for, in a challenging environment, it allows for deals to close and close with cash. So how does that dovetail with the headline that we typically see that redemptions are off the charts? Well, they are really high. They're averaging in the 90s at this point, sometimes upper 90s. But the redemption rates are just not relevant, because most SPACs have learned that they're not reliant on the trust cash to fund their business combination. As we just saw in the prior slide, it's all about being flexible, finding some sort of convert, some sort of pref, some sort of forward purchase. All of these things have been invented largely or borrowed from other parts of industry to assist SPACs to close their business combinations. And maybe this is more interesting for the room. I think it's more interesting for us. As a SPAC sponsor whose very first, and I think our first 5 transactions focused on Asia, we recognize the value of the US public markets, primarily the liquidity, potentially also the accretive profile for Asia-based companies. And so this chart is interesting because, of course, the highest profile de-SPACs tend to be Western. But on average, while Western de-SPACs outperform in the very short term, over time, at a year, which used to be short-term and is now, I think, long-term for most people. Over time, Asia D-SPACs actually outperform. I think that's telling, because ultimately these are equities looking for supporters. It's price discovery. And if it means that ultimately Western deals that look great and think they have support ultimately don't, then the opposite is true for Asia-focused or Asia-based targets. They may not look great to Western eyes initially, but ultimately that's a material difference in price performance. We didn't put up the IPO performance for the same period, but it's slightly worse, which is again something that the press often misses. But I think they're starting to pick it up. So again, what matters for a D-SPAC? The sponsor's got to have a clear goal in mind. It's got to be within their ability to accomplish for the most part. The target, it's helpful if the target's realistic about what the markets are giving in any particular environment. Maybe it's not critical, but it's helpful. And then ultimately, there are a lot of advisors out there, and the advisors usually have some experience, and they can guide toward an optimal path, or at least away from the suboptimal path. And so target businesses that have audited financials, that can meet their own minimum cash needs, at least through the business combination. And a team that has capital market savvy. Ultimately, going public is going public. It's like an extra business line in any company. Companies that go public and don't apply a capital markets IR strategy tend to underperform dramatically. Companies that go public and recognize that it's a whole new business line, they need to work with IR specialists, those are the ones that tend to outperform. And of course, investors. What we saw in late 2001 through 2002 were for those targets that really needed equity, they needed to know where their friends were. They needed to know where their strategic supporters were. And that ultimately made the difference. That's the story. That's where we are today. I'll just give a couple words on where I think we're going. Ultimately, I think we're going to see a lot more liquidations. We saw another couple over the last couple days. And this will be a better time for SPAC teams who are considering taking the vehicle public, because there will be less competition. And ultimately, hopefully, they should have a sense of their goals. As I said, having a viable set of targets. I think we're seeing more entrepreneur-led SPACs with better business plans taking them out. And I think that this is, as I said from the beginning, I think this is a return to normalcy for the SPAC universe. If we all get lucky and equity trading comes back, it'll be easy. But even if it's not easy, these transactions are then viable. Thank you.
Thank you, George, for kicking it off. I think that gave a really great overview from a historical perspective that's longer than 3 years, which is sorely absent in the press when they usually cover the topic of SPACs. So I think it put everything in perspective. A little bit sobering, but also optimistic as well. So thank you so much for kicking us off. So our next speaker is truly a veteran, both of the SPAC world and of Asia cross-border transactions. Somebody I've known for 2 decades, consider a good friend. Mitch Nussbaum is the vice chair of Loeb & Loeb, and he's the co-chair of their capital markets practice. Whenever I look at a SPAC registration a D-SPAC registration statement, I tend to see Mitch's name on one side or the other, and so I ask him, like, how do you possibly keep track of all these deals? And he hasn't given me a satisfactory answer yet, but I assume he just has a perfect memory and razor-sharp mind. But his practice focuses on emerging growth companies And he also represents a number of the investment banks, I believe, including some of the ones who are our sponsors today. And he works on SPACs, follow-on public offerings, shelf takedowns, registered direct placements, PIPEs, and other private placements. He also regularly represents public companies regarding their SEC, NYSE, and NASDAQ listing compliance, and it is in regular contact with all of those regulators. So today we've asked Mitch to come and talk to us about the changing regulatory landscape for SPACs. And I think really over the last 2 years we've seen more changes than probably in the past decade in terms of how SPACs are treated by the regulators. So really looking forward to what Mitch has to say. Mitch?
Thanks, Crocker. Thanks for having me. Thanks for inviting me. Okay. No one told me how to use this. I guess I just hit the green button. Is that it? Before I get into SPACs, I think I just want to talk a little bit about, Asia, a little bit about us and the people that I see in this room. I got into SPACs at the very beginning, early on. It was over 20 years ago. But before I got into SPACs, I was doing a lot of work here in Asia, predominantly in mainland China and Hong Kong. Actually, I went to this pre-conference dinner last night, and I saw a bunch of people there, and I saw some of you here, and it's just astounding to me how many of those people that we were working on these deals 10, 15, 20 years ago, 25 years ago are here, now. And I see some very, very familiar faces. Obviously, Crocker on the IR front for 20 years, Drew, I see in the front. I've been involved 20 years. I see my good friend Susan Wu. I know she's looking down there, like really early on, 30 years. David Liu, I remember, talking about old times, back 15, 20 years ago. It's just amazing. And I think what I want to talk about before SPACs is that I think there's a story here that's bigger than SPACs. SPACs are just a vehicle, right? It's just a sort of like a vessel that takes you from one place to the other. We'll talk about why we think the vessel makes sense, what are the issues, what are the opportunities. But the big story here is, I think, what brings us together, which is that I think that there's a common value among many of the people here that sees the world a certain way, that sees globalization, as still the future, as working together as still the way to go, right? As using the best of each other to really build something, together. We see the bridge, and I think that's where, turned beyond to this, when I was like 26 years old, flying back and forth to China those years ago. There are certainly challenges that have come upon us over the last few years, right? The rise of nationalism, localism rather than globalism, people looking inward, right? We see it in some of the leaders in the world, whether in China, Russia, or some of even our leaders in the U.S. have espoused those principles. And so it's not been easy. It's never going to be easy. There's always going to be that tension. But what brings us together, I think, is a belief that some way, somehow, through all of that, working together is really the answer. And it's really bridging some of the growth here in Southeast Asia, some of the opportunity here with the capital markets that we have in the United States, that, as George says, is, the vibrant, deepest markets, in the world. And so, I got into SPACs because I was really just doing IPOs like everybody else of these type of companies. But then the SPAC vehicle came around, and then these Asian companies, started going into doing SPACs. I remember being involved in those early, Chardan ones that George mentioned. And many of the other ones, I think we worked with just at that time, just the majority of the Asian deals that were working through SPAC. So the SPAC remains, a very vibrant vessel, and we'll talk a little bit more about it. We've got to do the plug, right? So this is always part of the presentation. We'll get it out as soon as possible. So last year, we had a good year for us, right, for Loeb & Loeb. We represented the most issuers in IPO SPAC transactions in the world, and we also we were involved in the most de-SPAC transactions of any law firm in the world. Like I said, we've been involved in it from the very beginning, over 20 years of working on SPACs. The $10 unit, that is the standard structure now, was a structure we actually created in our office in 2005. We listed the first ones on the National Securities Exchange because before then they were all OTC before we found a way to get them listed. And frankly, we did the first foreign SPACs that were listed on the Cayman, that were incorporating Cayman or re-domiciled to Cayman. That was a response to some of the needs of our Asian issuers at that time. So we did pioneer those things. Let's go into recent trends in the deal flow. Look, right now, we're going to have an honest discussion right now. There are some real headwinds out there, right, from a market perspective and from a regulatory perspective, and we're going to address both of them. There's no question about it. But again, the problem is when you analyze SPACs with everything, what are the alternatives? We're going to keep coming back to that. What are the alternatives in this type of market? We know that the SPAC IPO grew exponentially in 20 and 21. We went to over 83 billion and then over 160 billion in SPACs that went up, that were raised in those years. It's a tremendous amount of money for the SPAC product. Never seen some type of growth like that before. We saw that go down. So we went up to 613 SPACs in 2021, all-time high. Who knows whether we'll see that again? It could be a long time till we see that again. And we saw that go down to 86 IPOs in 2022, right? And then now what we're seeing, or 83, what we're seeing this year, just in the first 2 months, we only saw 7 IPOs. So it just shows you, how things have moved in terms of the number of IPOs. But what you do see is a very, very active and robust de-SPAC market, right? Because there's all of these SPACs that are out there. So we're seeing something like over 200 de-SPACs occur every year. 153 announced in 22 and 225 in 2021. And as far as this year, because you have 300 or 400 looking for SPACs, you'll probably see another 150, 200, 225 get done or get worked through one way or the other. And I think that's an important story for SPACs going forward, which we'll touch about at the end, is because a lot of that 613 from 2021 and the 248 from 2020, it's a lot of SPACs, that have to do something. And they're either going to close a deal or they're going to liquidate. Right now, what we're seeing, frankly, is that either these deals, some of them are liquidating. We'll talk a little bit about why those are liquidating as opposed to others. We're seeing some get done and announced. We're seeing a lot of them extend their terms, right? That they basically had 9 months, 12 months, 18 months to get a deal done initially. Everyone thought the cliff for SPACs was going to be now, February, March of 2023, because if you look at the 18 months from 2021 in terms of when they were supposed to expire, the cliff was supposed to be now. And what people are starting to realize is the cliff isn't now, the cliff has been postponed, right? Because a lot of these deals are extending their time frame, and so the February, March cliff of 2023 is looking more like September, October of 2023. So there's a lot to work out here in the next 6 or 7 months on these deals, and potentially even longer. A SPAC, we talk about that there's a 9, 12, 15, 18-month term, depend on the SPAC, but you can stay listed for 3 years, right? So you can continue to extend for 3 years. So if you want to take worst case scenario, and you look at the 613, this is just math. We look at the 613 that were done in 2021, and you count 3 years from there, you could have this de-SPAC thing go on into 2024 even. I don't quite think it'll be too much into 2024, but I do think we'll get through much of this year working through the de-SPACs of these old deals. The thing is that now, instead of just talking about gross numbers, let's look at the overall market share of this product. Because in last year, in terms of the IPOs, in 2022, this is not even 21, 22, it represented 77% of all IPOs. In 2021, the big year was 63%. This year, with only 7 IPOs, we're at 50% of the IPO market, which shows you the IPO market really isn't that big, right? It's the SPAC IPO that represents just a completely proportionate share of the IPO market than it ever has in the past. Because prior to 2020, in normalcy, we were looking at like 20 to 28%, like all IPOs, 20 to 28% of all IPOs were SPACs. And now we're seeing, a product that makes up more than half of all IPOs, if not, significantly more than that, in the 60 to 80% range over the last 3 years. So it shows you, that alone shows you that, in terms of alternatives, it's not that big, right? SPACs are a very, very significant part of it. In terms of Asia, this just shows you how many we have going on in billions of dollars in NASDAQ in New York. We have over 15 deals going on right now in terms of the mergers on NASDAQ, and call it another 5 in New York. The other exchanges locally don't really present a threat of taking any of those in terms of market shares, unlike Europe, for example, where you see some local markets try to list SPACs. We don't see that much of that in Asia. There was some talk about Hong Kong doing SPACs. Hasn't really materialized all that much. There are a few in Korea, but basically the SPAC product is essentially a US market. What I will tell you over my experience is that these are the markets where the Asian SPACs become more significant. These markets, right? And these markets to me look a lot like 2008, which we lived through. What happened in 2008 was that, when like if you look at 20 and 2021, when the SPAC market went wild, so did the domestic deals. There were a lot of domestic deals that dwarfed the number of deals from Asia or other parts of the world. What happens here is that when we get into these type of markets where we are right now, that's when we start seeing the resiliency of the Asian deals, right? Because there's a steady diet of companies from this region that want to go public in the US, that need to go public in the US, that need to find a way to go public in the US. And they're not necessarily, although everybody, adjusts, everything adjusts with the market, it doesn't nearly adjust quite as much as the domestic number of issuers. And so you'll see a steady diet of companies from Asia access SPACs. And because of some of the points that were already made, which is the certainty of the outcome and the flexibility that this product allows to be able to get a deal done, which is very, very important for people over here. I know that there was a slide in George's presentation in terms of how Asian SPACs, like over a year, have outperformed US SPACs. Look, let's be real. You could look at these statistics a few different ways. I've run it a few different ways. That could be true if you look at it some ways. It could also be true that some of the biggest challenges for Asian SPACs, frankly, are sort of the operations of these companies after they de-SPAC, like how they actually exercise corporate governance, decisions that are made in the capital markets, the sophistication of the management team in the capital markets. I mean, this is something, to be frank, this is something that companies over here need to work on. It's come a long way over the course of the 20 years. I mean, we all know that. Those of us that have been in China like 20-something years ago see that, but there's still a long way to go. And I think that's really the difference between some performing and not performing. A lot of these companies actually do have the cash flow, the net income, the EBITDA or whatever that some of the US deals, the EV companies, for example, the battery companies that we saw that had very little revenue, huge valuations from the US, don't have. But I think the terms of improving management, transparency, corporate governance, these are issues that we need to continue to work on in terms of companies going public. These are some of the examples of deals that have been announced really from here in 2022. You can see how many of them are actually from Singapore. These are 9 deals that were actually announced in 2022 from Singapore. I think we've acted on 5 of these deals. Now let's talk about the real issue that we're dealing with from the market standpoint, and then talk about how it ripples into the regulatory standpoint, and that's the funding sources. because everyone loved how there were tons of money coming in 2020 and 2021. There was a lot of money sticking from the trust, and there was a tremendous amount of pipe availability. Look at the numbers from 2020 and 2021. I mean, we had, like in 2021, $61.7 billion of pipes into SPACs. Look at how that went down in 2022. Went down from 61.7 to 9.2 billion, pretty dramatic. Although we still have $602 million of SPACs somehow in January and February of 2023, although it doesn't feel it because it's pretty much stays within a few of the top deals. And look at the redemption rates. Look how that has moved up significantly from 38% in 2020 up to over 90% in 23. So the big question with SPAC is, okay, I'm going to go public. I've got a certain process to get to the finish line. That's great. But what about the money? How am I going to raise money? How am I going to fund this deal if all the money is leaving the trust and it's very hard to raise pipe money? So, I think that there's a few things that we could, talk about there. First of all, let's go a little bit deeper and try to understand exactly why it's so dramatic with SPACs. First of all, we already saw that just the IPOs just don't go out in these markets, right? They just sit there. They just don't price. So you don't necessarily, it's not as dramatic. You just, they file, they go nowhere, they withdraw, they don't file. That's where IPOs go. What happens with SPACs is that there's a cascading effect. So when we saw, for the SPACs to work, you need to see a stock price go above $10, right? Or above $10.30, $10.40, whatever the interest component is there. Because then investors will trade out of it and money will stay in. Or if they trade above $10, pipe money will come in at $10, or even if it's a little bit lower, and they'll see a return. Everybody sees a natural return over $10 or $10.50. So when interest rates were low, money was coming into the market, right? Prices were up well above $10, $11. We saw deals trade over 20. We saw deals trade over 30. Huge returns for pipe investors, and no one's going to redeem at $10 or $10.30 if they could sell in the market at $15, $20, right? That's why all the money stays in. That's why you get a lot of pipe money. But we saw a cascading effect, right? Because we saw higher interest rates. Higher interest rates lead to less liquidity, less investors, stock price devaluation, particularly in the smaller names, right? You see a lot less of that in, like, when you look at it's always deceiving to look at the, Dow Jones 30 or the S&P 500. This is a different product, right? Let's forget about the Dow Jones 30 and the S&P 500. This is a different story here. This is like public venture capital for the most part, right? I mean, we could argue that, we could talk about that, but I think you understand the point. So these things, these type of growth stocks, let's call it that, like earlier stage growth stocks, they're not performing well. We saw that other slide in George's presentation in terms of market performance going down like 40, 50%, IPO and SPAC performance. That means they're going down below $10. That means that why are pipe investors going to come in at $10 so they can invest into a falling knife? Why are people going to not redeem if they could redeem at 10 something, keep a free warrant, right? Why are they going to stay in a stock that they know is going to go down, right? So this cascading effect of high interest rates, less liquidity, less investors, lower stock prices, growth companies doing worse, has a tremendous cascading effect on the SPAC product. And that's why we see the redemption rates and the pipe availability be so low. But there are solutions, right? There are solutions. The funded sponsor, great solution. Boy, in this market, you're a funded sponsor or you have real access to capital on a deal, you're the only game on town. Because who else is going to compete with you? You're the real deal. That's why those deals are still doing well. So if you're a funded sponsor, you hold the chips, you hold the cards. You could still do something special. Some targets are looking at this like 2008. Like, okay, so fine, there'll be less money there at the time of the closing, but I'm going to go public now. I know some of these SPACs, there's a trade-off here. I know that some of these SPACs, there's a lot of SPACs out there. They're competing over me. They're fighting over the same deals. Maybe I can get some better terms for myself. Maybe I'm going to see less dilution because I'm going to see all these people redeem. And when the market opens up again, which it always does, no matter how dark it seems at any time, the sun shines again. It always does. they'll be the first ones to go out in the follow-on offering and raise money at a good valuation, and they wouldn't have suffered the dilution that some of the other ones did before them. But again, these are companies that are not necessarily needing huge amounts of capital on day one to go public. So this is where we're going to talk about what structures have evolved to address the funding issues a little bit more specifically. So we have to talk about a few different prongs of attacking this issue. One thing that has happened is that there's been a proliferation of non-redemption agreements or forward purchase agreements. These are agreements where you go to public investors and say, listen, don't redeem. I'm going to pay you not to redeem. I'm going to pay you to stay in there for a period of time, give us more time, and then we'll work it out later, right? So, there were some massive regulatory issues with that. In March of this past year, the SEC came out with a CD&I. I'm not going to get too technical, but basically, they provided parameters where we could do these deals. So that's not a tender offer, because people were worried, well, if you start going to different people to tell them, contract with them not to redeem, this could be a tender offer. You could be violating the tender offer rules. We actually were very active in working with the SEC on the CD&I and with NASDAQ. And the CD&I came out in March, and so you see a lot of these forward purchase agreements and these non-redemption agreements, but they're still evolving, and I'll talk a little bit about that. So that's sort of like the first prong. We talked about convertible debt, preferred stock, all sorts of discounted, floating, conversion rates, and so forth. All this has come out. So the point of flexibility, the fact that there's several different ways to attack the funding for these type of deals is important, because when you do an IPO, that's it. I mean, you can't have what we call integration issues. You have to go register with the SEC on one type of deal only, and you can't, if you start implementing different layers of equity, debt, different types of private placements, it could actually abort your deal or it could delay your deal significantly. So with the SPAC, all of these different things are coming into play. We talk about long stop date issues. I think, deadlines are important with regard to SPACs. Time frames are important with regard to SPACs. You have to keep that in mind. Audits are very important when it comes to SPACs. Like, what are the time frames that are necessary here? Companies that need to get a deal done by a certain date, you got to be careful. This is a process where you have to get through, a proxy or an S4 review process. You have to get through a NASDAQ approval process. The SPAC has its own deadlines. Targets have their own deadlines. These are things that need to be thought through very, very carefully at the very beginning of a transaction. How do you keep the SPAC alive if this goes beyond a certain date? If there's a drop dead date in a merger agreement, is there flexibility to keep the merger agreement going to make sure that the deal gets done? Is there flexibility with regard to a financing or a minimum cash contingency, right? There's all these things that we're talking about that are going to be floating around over the course of the deal. Markets are going to change between signing and closing. Is there flexibility to be able to work through those issues between the date you sign a merger agreement and between then and when you close the deal? And then what I talked about is avoiding thinly capitalized business models to improve attractiveness of target. One thing that was a little bit scary in 2020, 2021 were these like super high flyer companies, very low revenue, needed like hundreds of millions of dollars to close the deal. Worked great in 2021, but that was a unicorn in the span of this product. Those deals have never really worked very, very well. We got lucky for a couple of years for all the reasons that were already mentioned. But this has not been the way this product has worked. This product has worked for companies who are looking to go public, want the certainty, want the flexibility, find a way to get a deal done, and then sort of build a real, public platform, after that. So in terms of other terms that have evolved, because the market has been more challenging, trust funds have been overfunded, higher. Investors are looking, you have higher interest rates. You're competing against people who are getting like 5% in treasuries. These people aren't getting like 0.8% in treasuries or 1% in treasuries like they did in 2020, 21. You have to compete with that treasury yield. You have to offer that treasury yield plus the warrants. So you're going to fund more in the trust. The terms are going to be shorter, right? There were years where we had 24-month trusts. Those were pretty much gone. I mean, it's 18 less, plus we have to build in extensions. That's a whole topic in and of itself in terms of how we deal with extensions. Do you require a shareholder vote every time you need an extension, or do you put in provisions where you can automatically extend and make your life easier? These are things that need to be thought through. The topic of the excise taxes has come up last year, and I'm going to talk about a little bit of that in the politics of this product, because I think that's important, particularly for people here to understand. But there's terms that you could put into these documents that deal with these excise tax issues that we haven't had in there before. The underwriters here aren't going to like this, but I have to raise it. You got to deal with what are you going to do with the back-end underwriter fees, right? If you have very little money at the time of the closing, and there's a $200 million SPAC and there's $7 million of back-end underwriter fees, for example, you got to have a plan for that, right? There has to be a way to deal with that. These are all issues that you have to deal with at the time of the merger. Recent trends. Again, we talked a little bit about some of this, so I'm going to try to move a little bit quickly through this part because it's a little bit more technical, and we could talk a little bit about more of this offline. But I talked about the extension votes. I talked about payments into trust to sort of keep money there and not redeem through an extension or a larger period of time. I talked about stronger targets dictating deal terms, better economics, lockups, earnouts, forfeiture of promote securities. These are all devices that that you try to sort of put into place to align the interests of the deal with the sponsors and try to present a stronger deal to the market. Again, there's a lot of strategy with that, but I'm not going to go into too much depth about that right now. We talked about pipes priced under $10 given the current market environment. Talked about non-redemption agreements and bonus share pools for non-redeemers. These are strategies to look into as you negotiate your merger agreement in this market. Now let's talk a little bit about the U.S. regulatory pressures, because I guess I was supposed to talk a little bit about that, but it seems to be like the less interesting part of the whole thing. So, but I don't want to not mention it. So look, last year, in the wake of 2021 and all of the attention that SPACs received in the media, right, we saw some backlash. And so I think it's important for people here to understand like what really happens, when it comes to this. There's politics when it comes to these things in the U.S. just like there is anywhere else. There's always been this sort of like Main Street versus Wall Street dynamic, right? Where you've got, and I think personally, and again, this is a bit of my own opinion. It might be a little controversial, but I don't care. Senator Elizabeth Warren seems to be the proponent of some of this stuff within the Senate, right? She looks at herself as the watchdog for Main Street versus all these people on Wall Street making tons and tons of money to the expense of the workers, right? And so every time you see a new product come out on Wall Street that's like all over the media, that's the new rage. We saw this with the collateral CDOs, collateral debt obligations, with some of the mortgage situations that we saw in 2008. And we saw this in SPACs in 2021, 2022, when they were all over the media. And so from that segment of the political spectrum, you're going to see this backlash that this reaction that comes out to it. These SPACs are like everyone's getting rich and the workers are getting screwed and the small people, so there's all of this type of thing. And the reason why I do say is because I'm not necessarily picking on her. Senator Elizabeth Warren did come out with her SPAC hack published in May 2022. And she did sort of try to tell everybody why the sponsors are making all this money. They're making millions of dollars, and the investors are like losing money, and the sponsors, and the underwriters are doing great. Of course, Elizabeth Warren has zero experience with this product in real life. She's never done a deal, right? She's never done anything when it comes to this. So she doesn't understand that these sponsors are putting up real money. If they don't get a deal, they lose all their money. Oh, and by the way, the public shareholders are protected 100% in trust. It's the opposite of what she said. But that argument wouldn't have served her political interests, so she only tells you half the story. So nevertheless, that had a significant effect in terms of the SEC and how the SEC looked at the product. So the SEC came out with proposals in 2022 and said, look, we've got to look at this product a little bit more carefully. We can't have companies forum shop a SPAC versus an IPO. The same regulatory issues that we see with regard to IPOs should apply to SPACs. they shouldn't be traded any better. And so that's what the proposals came out with in 2022. There was a tremendous amount of concern in the marketplace, the industry, and so forth with regard to these proposals, what's going to happen. We started seeing more disclosure in the documents. We started seeing concern that they were going to impose liability on underwriters for the SPACs, just like they did for the underwriters of the IPOs. They started looking at the fact that, wow, why are SPACs using projections but IPOs aren't? Shouldn't SPACs be responsible for future projections as well as the IPOs? So we started dealing with all of that. And they raised other issues too, which I don't have time to talk about. The point is that those proposals were never passed. I mean, this is all we talked about last year, were these proposals, how it was going to change the whole industry. And guess what? It never passed. What has happened is that the whole industry has already accommodated all of those proposals. And underwriters are already taking measures in terms of underwriter liability and doing everything that they would do in an IPO. People are already taking measures with regard to how they're publishing projections. People have already changed the disclosures. Those changes have been made. Why haven't they passed? Because they've probably moved on to bigger and better things. They only see 7 SPAC IPOs this year. Why are you going to hit an ant with a nuclear bomb? It doesn't make sense. This thing is already so much smaller than it was. Number one. Number two, I think they moved on to other things, like the crypto companies. God forbid you want to get a crypto company through the SEC right now. Good luck, because after FTX, this seems to be all they're worried about. So the SPAC has sort of like diminished in terms of their overall concerns. It's not in the headlines that much anymore. So they're not spending as much time about it. I think one thing that's really, really, really interesting to highlight the point that I'm trying to make here is this excise tax issue that came up last year. So what does that mean? They're basically part of the Inflation Reduction Act was that, stock buybacks, when a company did a stock buyback, they would impose an excise tax of 1% on the buyback. So you could understand that if you're like a very large multi-billion, trillion-dollar company of stock buybacks, there's a lot of money leaving the company coffers to buy back stock. Really good for investors, right? The Elizabeth Warren arm of her party is looking at it like, oh, that's money that could have paid for jobs, that could have paid for employees. These aren't good, right? So it was like, let's try to penalize these companies who are taking cash, buying back stock, helping the investors that are using that cash and paying the labor force more or increasing the labor force. I mean, right now what we've seen is, Warren Buffett came out 2 weeks ago. I thought it was very interesting with his letter to shareholders arguing why the stock buybacks are really, really good for companies. And let's be real, are these companies really going to spend all this money on employees? They're still going to watch their bottom line anyway. But what's so ridiculous when it comes to SPACs is, when SPACs redeem or investors redeem, are those monies ever going to go towards hiring people? It's no chance, right? Either they're going back to the company or they're going into the resulting company. So it's something that may have been misapplied, but it was something that created a lot of concern, particularly in December, when they saw that this excise tax would apply in this year, and that was the reason for some of the liquidations we saw at the end of 2022. I think there's also, I just really want to highlight the exchanges. The exchanges, I'm going to flip through a couple slides. I think I covered all that. The exchanges have really taken a hard stance with regard to SPACs recently, because with all of these extensions that have happened, they're now taking a look at this and they say, well, okay, now there's this extended SPAC, now meet our listing requirements. And that's created a lot of issues that people didn't foresee going into all of this. So when people redeem at the time of extension, there's less shareholders, there's less money in the public float. The New York Stock Exchange, I think, froze trading for like 13 SPACs, like within a week period of time. NASDAQ has actually, done some other stuff too. So, there's a lot to think through when it comes to these deals from a regular. The landscape changes on a weekly basis or a monthly basis here, depending on what the temperature. The NASDAQ, the New York Stock Exchange, they keep coming out with new policies and think that they enforce with regard to the number of shareholders you need here before and after the extension, the amount of public float. So I think you need to be careful, very careful about that when you think about these deals. So in terms of surviving the perfect storm, which I think we've laid out the reasons for that, again, just take a look at these things. Lack of financing commitment in either the trust or the pipe. Understand that this is a reality. You need a plan for that. understand the regulatory developments that I, briefly highlighted in terms of the exchanges, the SEC, what that could mean in terms of challenges for these deals, and then flavor of the month, because it changes, right? Like people a year ago thought, oh, we're going to do a crypto deal. This is going to be a great deal. Now they're stuck in the SEC, right? A year before that, we had a bunch of Chinese companies that were stuck with the SEC because the SEC wasn't clearing Chinese deals. Now they're clearing Chinese deals again. Maybe one day they'll clear crypto deals again. But there's always, some flavor that they're worried about, and I think you have to sort of stay on top of that. So I just want to close, because I see my time is up to 0, and circle back to how I started, which is that I've been doing this for, it feels like most of my entire professional life, and there's nothing but challenges and ups and downs here. Particularly doing SPACs in Asia, the flavors of the month change constantly. There's always going to be, people who who are going to predict the worst. I can't remember how many times people said SPACs were dead. How many times the media have said that, how many times people have said, a lot of these companies from Asia, I don't know if they're going to make it. We're still here, and a lot of us are still back here. And I think that just talks about the resiliency with this market, the importance of this market, and the importance that we all continue to work together towards something a lot bigger. Thanks.
So Mitch, thank you so much for those remarks. I know there was a lot of technical detail in there, but the good news is that we're now headed for our coffee break, and so Mitch will be available to explicate all of those legal terms that he flew through in his presentation for anybody who wants more detail. So we have a half-hour break. I encourage you all to grab some coffee and some refreshments, and we'll see you back here in half an hour. Thanks you so much.